Hello and welcome to CAP STRAT this week. Mike, let's get right into it. We can start by looking at the equity market details since 2022. Kind of been changing a little bit here lately. What's been going on?
Opening up, broadening out. Since November 1st, 2023, we've had a nice strong rally, very inclusive rally. Yes, the Magnificent Seven have led the way, but closely behind small caps, the Russell 2000 up 28%. The other 493 actually making some money, up 24.5%. Every area of the equity market beating cash. So quite different since November 1st. It's become even more inclusive during the month of March. That's when a lot of the Magnificent Seven are starting to wobble. Really only like Magnificent Two left. And we just wanted to contrast that to these other time periods since 2022. As we get into the middle, from early 2023 through October 2023, the only thing beating cash, the Magnificent Seven, up 78.4%, a very unique performance time period. Every other area of the equity market, of global equity markets, basically underperforming cash, and then these seven stocks up 78%.
Right.
And then, of course, we all remember 2022, cash was king. Nothing beat cash, and the Magnificent Seven weren't even magnificent back then. They were down 45% in 12 months. Have to remind people, these seven stocks, they can go down.
They can and they have.
Yeah, not that long ago.
Yeah,
Yep.
yeah. So indications here, and we've talked about this, since 11/1 time period, as the market's starting to price in some potential for perfection, or at least an expectation that the Fed is going to cut rates soon. But that hasn't happened yet. As we're standing here in April of 2024, not only has the Fed not yet cut rates, but now June is down to a coin flip.
Mm-hmm.
So, why is that happening? Why has the Fed been so hesitant to cut rates?
And it's something we flagged earlier this year. It's not the overall level of core inflation. That's coming down towards cutting territory, especially as we get to June. We think core PCE will be running below 3%. The Fed should be able to do adjustment cuts. But it's the mix. It's the underlying inflation dynamics. If you look at core CPI and you separate it into three baskets, it's the services x shelter, the green line. Over the last 6 months, on an annualized basis, up 6.1% and accelerating, going the wrong way. This dynamic is what, in our view, coming into the year meant the Fed will likely be able to cut, but far later than the market was expecting. Heading into 2024, rate cut expectations were, they were right around the corner. Markets were thinking maybe January, then maybe March.
Yeah.
And our view was, no, that's far too soon because of these dynamics. So this has definitely put the Fed on hold for longer and potentially creates a risk. Are these dynamics significant enough that the Fed would say, I don't want to prematurely cut rates in the face of what looks like the beginnings of a wage price spiral and relive the mistakes of the 1970s,
right.
So I'm not cutting this year. That fear, we think it's there, but it's a little overblown.
Yeah. So that fear of too hot of inflation preventing the Fed from cutting has kind of worked its way into the market certainly over the past couple of months here. You can see since that time period we talked about a little bit earlier, 11/1/2023. From there, the market got all the way down in the sense of this chart to expecting more than 6 cuts in 2024. Now, all the way back down to where we were coming into the year, thinking 2-3 cuts. Market deciding between those 2 points. But this is a big shift just over 6 months, going from 2 cuts to 6 cuts and back to 2.
Right.
And equity's kind of going up and up along the way.
And you can see the volatility. The market can take something and absolutely run with it. When we got into early 2024, the market expecting, as you said, 1.6% worth of cuts, approximately 6 25 basis point cuts, when the Fed themselves had said 3 25 basis point cuts. Now the Fed has stayed firm, despite the economic data coming in stronger than expected, the labor market data being relatively solid, and those inflation dynamics. The Fed has said, we're sticking with our 3 rate cuts in 2024. And we've said the same thing. We're sticking with our expectation of 3 to 4 cuts in 2024. But the market has now perhaps overcorrected in the other direction. And the risk now to the equity market rally You would think going from 6 cuts to 3 was a risk, but it turns out the market was fine with that because there were still cuts on the table.
Yep.
The risk is we go to 0. Cuts get totally priced out.
Right.
The Fed is not able to cut this year. We think that's overblown at this point. We'll talk about that when we get into our inflation forecast. But that is the risk that markets are, as of like today and yesterday, starting to really grapple with.
Yeah, yeah. And if the Fed isn't able to cut as soon as the market expects or as much as the market expects, this phenomenon that we've been talking about for some time is going to stay in place a little bit longer, right? Tia, there is alternative. We've still got, 3-month Treasury bill out yielding the S&P 500 forward earnings yield. Mm-hmm. How do Fed expectations play into how this dynamic could change or how we're thinking about that?
Until the Fed cuts, you get 5.25%, thereabouts, investing in a money market fund. And you compare that to the 1-year forward earnings yield on the S&P 500 at only 4.6. That, in theory, shouldn't happen. Why would you expect, or why would you accept a lower expected return for a basket of risky stocks than you would a risk-free asset? This doesn't happen often. The last time it happened was right before the tech bubble burst.
Yeah.
So this is a reason why we said coming into the year, markets actually are vulnerable for a pullback, because the S&P 500 is priced for, 3 to 6 rate cuts. At one point it was 6, now it's priced for less than 3. And a certain area of the market is very expensive, priced for absolute perfection. Mega cap growth stocks, including the Magnificent Seven.
Right.
And those types of stocks dominate the index. So if they wobble, the whole index is going to wobble.
Yep.
So still, in our view, and higher for longer, warranting somewhat defensive positioning here because of this dynamic.
Yep, absolutely. And to that point of, certain areas being particularly vulnerable to a pullback, the way we think about that, at least from a long-term perspective, looking at each of these areas of the equity markets, distance from their long-term trend, right? And you can see here, NASDAQ 100 kind of stands on its own, right? 68% above its long-term trend, while small growth, large value, and small value all around even below their long-term trends. So, what's going on here? This is such a significant detachment.
There's bubble talk right now because the S&P 500 is near its all-time highs, and it's gone up so much so quickly, and it's led by a relatively few number of stocks. That's understandable. Our framework suggests there's really only one bubbly area of the market. There actually are opportunities elsewhere, especially when the Fed is able to start cutting interest rates. Not like the early 2000s in the tech bubble. There it was, pick your dirty shirt.
Yep.
Right? What's the cleanest? Now there actually are opportunities outside of those mega cap growth stocks. You just need the catalyst for a rotation to materialize.
Right. And that catalyst we've talked about, potentially being Fed cuts, right? But even so, we talked about we haven't seen any Fed cuts yet, but it looks like this shorter term rotation could be starting to happen.
Right.
What, as we sit here in April 24, what do we need from the Fed in order to make this rotation happen?
Well, the magnitude of the recent outperformance of mega cap growth stocks versus smaller cap value stocks in and of itself means, in our view, a rotation is coming. If you just look back at the data, from mid-March 2023, when there were bank failures in the US, to 12 months later, mega cap growth stocks outperformed small and value stocks by almost 50% over that 1-year rolling period.
Right.
That's the 4th largest magnitude since the beginning of our investment framework in the 60s. Every time that's happened, a reversal has followed.
Right.
Investors naturally, by nature, hopefully, should be looking for opportunities to sell high and buy low, right?
Right.
And so we think that reversal is coming. We think the rate cuts are the catalyst. It's just a question of timing. We still believe the Fed will cut 3 times, first in June, then in September, then in December. If that's the case, this rotation is something that investors should be actively preparing their portfolios for.
Right.
Right? If those rate cuts get put on hold or there are no cuts this year, That doesn't mean that this rotation thesis is out of the question. It means it's put on hold for a little
Right.
while.
Yep. Just pushing it back a little bit.
Yep.
Sure. All right. With that in mind, let's get into the framework. Starting with inflation, we talked about it continues to be a relatively soft picture, especially compared to 22 and 23. Expecting 2.5% at the end of the year this year, which would certainly suggest Fed cuts.
Right. And if the Fed were to reverse their language and start talking about hiking, we would need to see core PCE on a year-over-year basis trending back up.
Yeah.
We're not seeing
Right.
that.
Yeah.
We're not seeing that. And when we look at our forecast, as we get to the June Fed meeting, core PCE should be running firmly below 2.5, with our forecast saying it should continue to move lower from there. That's very conducive to the Fed making adjustment cuts.
Yep.
So that's why we still think 3 rate cuts in 2024. And then you think about the biases here. If any weakness in the labor market transpires, from now through the end of the year, the Fed will change their tune, because then they're thinking, what are we doing not cutting?
Right.
Keeping rates high is sort of, with inflation coming down like this, it's all risk, no reward. So that's a more complicated way of saying we think that this inflation picture allows the Fed to be cut biased.
Right.
Much different than 2022 when they were hike biased.
Right. Exactly.
And even much of 2023. And so that's important. So you may not get the first cut in June, but if the labor market breaks down in July, the cuts could come quicker.
Right. Yeah. And another layer of that cut bias is, the expected Fed reaction to a surprise one way or another. Let's take inflation data, for example. If you see a big downside surprise in inflation, Fed is very likely going to cut, right? But if you see a big surprise in inflation, they're not very likely to hike. They're just going to hold off on cuts, right? So, and speaking of cuts, checking in on our liquidity forecast, continuing to include those 3 expected cuts that you've referenced here. And again, the liquidity picture expected to improve somewhat healthily in the second half of the year.
Specifically within our investment framework, this is the catalyst for the broadening out of the market rally.
Yep.
It's the improving liquidity conditions, it's money supply growth rebounding from the worst slowdown in money supply growth in history to something that's a lot more benign.
Right. Yeah.
And that's already, in our view, starting to happen.
Exactly. And on the economic growth front as well, expectations continue to rise modestly for 2024 full-year economic growth, north of 1.5% for the 12/24 estimate here.
Yeah.
So, and lastly, checking in on recession. As we talked about, labor market looking okay, no even yellow signals here from a labor market perspective. Equity market stress signals, still just some pressure in commodities, but really, really tame recession signal. Certainly not active at this point.
Yep.
All right. Well, that will do it for this version of CAP STRAT this week. If you have any questions or comments, please feel free to reach out.